Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
We learn from experience that men never learn anything from experience. The saddest aspect of life right now is that science gathers knowledge faster than society gathers wisdom. Technology is a word that describes something that doesn't work yet. Writing about music is like dancing about architecture. The difference between fiction and reality. Fiction has to make sense.
Here's a chart that basically says, if you're not saying AI on your earnings call, are you even listed? By the third quarter of 25, a record 62% of S&P 500 firms dropped the magic acronym, some with genuine strategy, others with the enthusiasm of students adding blockchain to a college report in 2018. This curve isn't just going up, it's doing cardio. Companies are now treating AI like a universal seasoning, sprinkle it on anything and watch the stock pop. Here's an uncomfortable truth these charts scream. When the Fed starts cutting, the market usually keeps falling, and sometimes dramatically. The tech bubble, the cuts did not help. The Great Recession, the cuts did not help. COVID, only a fire hose of QE, that's quantitative easing, did the trick. And now in 2025, we are once again asking the same question with the same energy. Will cuts save us? Spoiler, probably not. Rate cuts during a downturn are like handing someone an umbrella after they are already drenched. Here's a plot twist. China isn't just lending to emerging markets, it's writing some very large checks to the richest countries on earth. The US alone grabbed a stunning $103 billion since 2018, making it Beijing's favorite borrower. Gas pipelines, airport terminals, if it needs steel, concrete or political awkwardness, China is in. And despite all the geopolitical chest thumping, money seems to have its own foreign policy. Lend where repayment actually happens. As Oscar Wilde might have said today, when it comes to money, everyone suddenly becomes good friends. The AI boom isn't just about algorithms and GPUs anymore. It's become one of the biggest borrowing sprees in corporate history. Since September, tech giants have been flooding the bond market, and global data center spending is set to hit $3 trillion by 2028. That's not expansion, that's empire building. Private credit, private equity, and securitizations are all rushing in, and which is exactly why investors are getting twitchy. When every pocket of the financial system is suddenly funding the same dream, the risk usually isn't far behind. As Charlie Munger might have put it, if you want to know what's happening, follow the data. India's FY26 second quarter earnings season landed softly, not bad, not brilliant, just a little gentle sideways shuffle. Median sales, operating profit and PAT are growing, but not exactly sprinting. EPS growth, let's just say, is doing the bare minimum to stay employed. And yet, the Nifty is brushing against all-time highs, which makes this earnings picture feel a bit like watching a car idling at a traffic signal while the speedometer insists that you're doing 120 kilometers per hour. Here's a fun surprise most investors overlook. Over the long term, the Nifty Top 10 Equal Weight Index has outperformed the broader market in 9 out of the last 18 years. In other words, a concentrated basket of India's biggest, steadiest winners has quietly beaten the Nifty 50, the Nifty 100, and even the Nifty 500. While everyone debates mid-caps versus small-caps, the top 10 stocks have been basically jogging past the entire market, waving very politely. As Peter Lynch might have quipped, if you can't find the next big winner, just own the winners already winning. India's November 25 macro dashboard tells a very familiar story. Growth is holding up, but momentum is clearly cooling. Festive demand gave a nice pop to vehicle sales and registrations, and yet GST growth slowed sharply thanks to rate tweaks. Services activity has softened, white-collar hiring has slipped, and the FIIs remained, let's just say, moody. Inflation, though, is the star of the show. CPI at 0.25% and WPI negative. With prices this calm, the RBI practically has a rate cut gift voucher waiting to be redeemed. Corporate India is absolutely loaded right now. Listed companies, ex-financials, are sitting on a 14.19 lakh crore cash pile as of the end of Q2 FY26, up more than 11% from last year. In short, balance sheets look like they have been hitting the gym. The top 429 companies hold nearly 80% of this mountain, thanks to strong operating performance and a spike in other income, which is always the mysterious hero of Indian earnings. And yet here's the twist. Despite all this cash, investment activity isn't exactly exploding. It's like India Incorporated showed up to the party with a suitcase full of money and then decided to nurse a Diet Coke.